So far, though, what we've seen is that the numbers that have come out have been very, very good, and guidance has actually been good. We haven't seen anyone cut numbers because of expected tariffs, but we'll see how that changes as the next few weeks unfold.
What are you expecting?
Well, I think in the short and the intermediate term, the market's fixated on very good economic numbers, the prospects for decent earnings. But I think in the longer run, and I rarely say this, as you well know, I think the market's wrong. I mean, if you look around the world and you look at economic nationalism, populism, the world is going in a direction that we've not seen for quite a long time. I don't think the market's ready to discount that, but it may one day be if this were to accelerate from where we are now.
Something we haven't seen, Bob Pisani, in literally a generation, and 2 generations in terms of trade, certainly, Ron, would you agree? But we haven't seen rising interest rates to the degree that we're seeing them now. Not that they're high, but they are getting higher.
Yes, but unfortunately for the banks, they're not moving fast enough. The banks are going to have a problem, and we've been underperforming notably because the spread between the 2 and the 10, which that interest rate spread that is so important, isn't working. We're only about 30 basis points, so I think that's an issue. Just to get back to Lindsey's point, I think she's right. The early reporters have not said anything about concerns about tariff and trade wars. The numbers for the 3rd and 4th quarter are not coming down at all. I think the bad news, though, is the market's not waiting for the analysts. They never do. They've already voted. In the last month, the S&P is flat. Industrials and materials have notably underperformed. Industrials are down about 5%. So the market's already reflecting the concerns that we have out there. The good news is the economy is doing fine. I think the bigger question is it's very clear that trade is the mover of sentiment right now. That's what really moves the market one way or another. And I'm with Ron, I do have very legitimate concerns out there about capital expenditures, for example, slowing down, notably if this goes on for much longer.
For sure, and that could really impact the tech sector. And the tech sector, arguably, I mean, that will be the most important sector to watch in that in the first half of the year, 4 stocks in the tech sector accounted for 84% of the gains. And I mean, we're so reliant on technology. If we see companies start saying, you know what, we may not spend as much as we thought, that's going to be on the tech sector.
And we're late cycle in every conceivable way, with small caps outperforming large caps, with the market getting narrower. If the president were to make good on every threat that he has put forth on the trade front right now, including the $500 billion threat against China, which is exactly what they export to us in dollar terms.
It's everything we take in.
Yeah. You would be back at Smoot-Hawley type, environment, 1930s, where, along with that, by the way, were competitive currency devaluations, which haven't happened yet. If they did, that would become an issue in which the dollar might soar, other currencies might collapse, and you would have some real issues on your hand, not only global markets, but the global economy as well.
Lindsey, the scouting report, and Bob did this story the other day, the industrials, technology, and financials are the 3 that are driving the market right now, and the most vulnerable when it comes to the trade issues right now. How do you view them at this point? Are you more cautious, or do you think that presents a buying opportunity?
I think it presents a buying opportunity. We are overweight the industrials, materials, and energy sectors right here. We continue to wait this out. It's going to be a bumpy ride over the next several months as the trade talks do evolve over time. We are believers that they will evolve and in a positive way. And I think the market really is viewing it that way. While the sectors have underperformed right here, I think that once we get through to the other side of these trade talks, you could see significant upside. You had FedEx come out. When they reported earnings, they reiterated their guidance for both U.S. and global GDP growth. So until we start seeing these tariffs take effect, which is starting just today, I don't think we can exactly say what's going to happen from here.
And I would just point out that while the U.S. economy is doing well, look at clues elsewhere for concerns about a slowdown in the global economy, partly due to the trade wars. I've been pointing out the DBB, and this is one of these ETFs that tracks metal prices around the world, particularly copper and aluminum. It's at a 52-week low right now. It's been going down, straight down, for a month now. Copper's been acting terribly. Agricultural commodities have been acting terribly recently. That's a tip-off to what the concerns are.
Platinum's at a decade low.
Yeah, and Shanghai Composite's down 22% from its high. It's down 32% from its high in 2015. The weak markets go first. And the question, to Lindsey's point, is when we get past this trade dispute, what if we don't get past the trade dispute? That's not remotely factored into stock prices, bond prices, commodity prices. We don't know where this goes. I mean, the president has shown a willingness to go farther than anyone thinks, And I don't think the market takes him seriously or literally, which may turn out to be a mistake.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.